which means your prime-rated banks now, prime lending rate is now 10%. I'm joined by Kevin Lings, chief economist at Stanlib, for some analysis on that. Kevin, thanks for coming in.
No pleasure.
Does this 25 basis points cut make a significant difference to struggling consumers out there?
Look, it's not going to make a major difference. It's ultimately just a 0.25% reduction in rates. So it's not as if consumers are going to suddenly feel a huge amount of relief. Generally, consumers have been under pressure now actually for a couple of years, and that pressure has built up through a range of factors, partly to do with wage growth starting to slow, especially in the private sector. We're finding that wage growth now on average has fallen below 6%, and in many sectors it's starting to head closer to the 4.5% to 5% level. So people have seen their wages come under pressure, and then consumers are also facing some cost pressure that is not quite captured with the inflation rate. So we know electricity prices have gone up, water prices have gone up, we've had some very high petrol prices, we're starting to see food inflation move up. So in general, we would say the consumer's under pressure. You throw in an increase in unemployment, and it's a difficult environment. In that environment, if you cut 25 basis points, what it does is it just relieves a little bit of pressure, but it's not enough to provide a stimulus. That doesn't mean you mustn't do it.
Yep.
It just says that you're providing a little bit of relief, and at the margin, it will inspire a little bit more confidence. And ultimately, it's not just about households, it's about the broader economy. And what this should do is just bring a bit more confidence back into the economic system in South Africa.
I see we're not using this phrasing as often as we did a few months ago, interest rate cycles.
Yes.
So, you know, consumers out there, I would imagine, shouldn't really expect a cycle cut that's happening. Now, we're not going to see several of them.
No. So we used to have that more pronounced, where we would go through a clear business cycle, and we would know that we're in a rate hiking cycle or a rate cutting cycle. That hasn't really been the case for some time. Obviously, the last move in interest rates was back in November last year, when the Reserve Bank actually hiked rates 25. Now they've cut 25. That is not reflective of a cycle, and I don't think that you would price in that the Reserve Bank's going to keep cutting every meeting or every second meeting 25 basis points. That, I don't think, is what the Reserve Bank is intending here. What they're intending is just to provide a little bit of support, a little bit of relief where it's possible, and the opportunity has opened up to do that, and they're taking that opportunity. I think it would be wrong for consumers to now expect, oh, we'll have another cut before the end of the year, and then another couple of cuts next year, and now we can become a lot more expansionary. We can take on debt and buy that car, etc. That's not what the governor's after here. The governor's seen a circumstance where things have got easier. The economy is still quite weak. The international interest rates are trending lower. He's cutting rates, providing relief. But if you listen to the statement, he's still warning about some risks.
Indeed.
Inflation's still going to go up next year. We've still got some risks around the currency. We've ultimately have to manage a range of factors here, not just simply that the economy is weak. So I think you're looking at this cut, a pause, and then he'll reassess later in the year.
There was a very clever way in which a political theme for me was addressed in one of those questions. I mean, he was asked, the Reserve Bank governor was asked whether or not there is an ideal interest rate figure that would be good for growth in this economy. Now, that comes under the backdrop of this tussle on the mandate of the Reserve Bank. Should it be more growth-focused, or should it maintain the stability of the country? And he handled that quite well, but I thought maybe you could sort of give us your impressions of what he said about there being an ideal interest rate figure.
So you could make an argument that given how weak the economy is, that South Africa should be having much lower interest rates as a way of just stimulating growth. And on its own, that would make sense. The problem is, for the Reserve Bank, that's not the only factor they consider. They consider where inflation is and the risks around inflation. So that means they have to balance the need to grow the economy against how to control inflation over time.
Yeah.
And by controlling inflation, they have to also control the exchange rate. And we know that if we were to cut interest rates very dramatically as a way to boost this economy, in all probability the rand would weaken, and then we would find ourselves importing higher prices, importing inflation, and we would undo very quickly the benefit of the lower interest rates. And so he doesn't want to get caught up in that, let's just go for growth. He's got to constantly find that balance. Now, in answering the question, he refers to the neutral interest rate, which is an interest rate which most countries want to try and get to for their economy, which says to you, I've got a level of interest rates which is helpful for the economy, but it's not so low that it's going to lead to higher inflation. It's an interest rate we want to try and maintain over a long period of time, and basically everybody's happy. Consumers are happy, businesses are happy, foreign investors are happy. You want to get to that. So there is kind of something like an ideal rate. What he's saying is that he can't quite get to that because there are specific circumstances. And then importantly in that, he's referring to the potential growth rate of this country, which he's saying is 1%. And he's saying that's way more important than other variables, and I would agree with that. And what that says, and this is quite damaging, if South Africa tried to grow its economy at more than 1%, we would end up with inflationary pressure. That's how tight the system has become. Because if we grow at more than 1%, we're going to put pressure on the system, and the system will respond by higher prices, etc. So what we've got to do in this country is find a way to lift the potential growth rate. And the way to do that is better skills, better electricity, better policy environment, so that your potential growth rate rises. That means you can grow the economy faster without generating inflation, which gives him some scope to lower interest rates. If he cut interest rates now, right, he would quickly lift the growth rate above 1%, but he'd quickly lead to inflation, and he wants to avoid that. And so the message, I think, if I was government watching this, I'd be saying, I need to find a way to lift the structural constraints on the economy, which are things like policy, electricity, education, or skills, so that we can grow much faster without it being a problem.
Yeah, and he said that in many words, exactly verbatim. Kevin Lings, thanks very much indeed for your take on that. Kevin Lings.